Hi, thanks so much for joining in. We're talking about Your Money Matters on NDTV Profit because we understand that your money matters. Now, in the mutual fund space, there's this propensity of retail investors to look at the past returns, and on the basis of the top performers in any given period of time, you decide which schemes to invest in or not. The thing is, that's not always the best approach to have, particularly when you can see very wild swings in the equity markets in a very short period of time. Take a look at just the last 12 months. In the run-up to September, you had the fag end of the upcycle in equity markets, and then from September onwards to where we stand right now, you've seen significant drawdowns, particularly at the broader end of the spectrum in the equity markets, as a result of which a lot of small cap and mid cap mutual fund schemes have underperformed, and also certain schemes that would have ranked at the top in September are no longer ranking at the top as things stand right now. So we're going to talk about two categories, that's the flexi cap category and the multi cap category, and talk about the winners as they stood in September and the winners as they stand as of now, just to drive home this point, and then we'll talk about how you should go about your own selection. Join me on this conversation. I have Santosh Joseph, who's a founder of Germinate Investor Services, as well as Mrin Agarwal, who's a financial educator and founder of FinSafe India. Thank you so much to the both of you for taking the time. In the advice and in the conversations that you have, is it often the case where people ask you why not this scheme and why that scheme, and often the schemes that they're talking about, Mrin, I'll start with you, the schemes that they're talking about are the top rank based on the last year or 2 years or 3 years. Is that what you always find?
Good evening, Alex. And yes, absolutely. That's what one always finds, that the conversation always seems to be about the funds that are performing well in the last 1 year or who've got recent good performance. And typically, people don't even look beyond 3 year returns. So everything is based upon what is recent performance.
Okay. Santosh, you want to build on that a little bit, because I'm pretty sure in the scheme selection that you do, sometimes the question is why this scheme is performed, say, has got an XIRR of what, 15%, whereas that is 24%. Why not pick that?
So yes, Alex, hi, good afternoon. Marino is absolutely right. The desire to be in a fund that has got immediate past performance is very high. So there are two kinds of investors. One, they go around and check which are the funds that are done well and wonder whether you're recommending the same, and they ask you why not. The other group of people, after you have kind of discussed with them that these are the funds that you should consider, they go back and see how they have done in the immediate past. So in both the cases, either they're suggesting that to you, or if you suggested, they want to look if it's on the top of the game. So chasing returns is the order of the day. Now, whether they do it after you recommend or before you recommend, asking to be invested into that, it doesn't change.
Talk about the data though. Let's not base this on simply words. Mrin, any data that you might have to suggest that this is indeed the case? Let's first look at flexi caps and then we'll move to multi caps and see how that panned out.
Well, I was just looking at the data as of 30th September. And when you look at the 1 year returns at that point, and I often get questions on a lot of shows that I do on certain funds. Obviously it's because these were right at the top. So when I look at the data, there were funds whose 1 year return was, let's say, showing 60% in the flexi cap category, which have now come down to, let's say, 17, 18%. And as of 31st January, and of course, they don't remain at the top. Right. So a lot of questions which are coming in on certain funds which were giving very high performance. And there are categories where the fund performances have also fallen drastically a lot. So when I look at like the top 5 funds as of 30th September and the top 5 funds as of 30th January, I think only two or three of them still remain as the top performers, but there are 2 of them which have gone down drastically, and there are others that have really come.
You want to talk about the names that you're talking about, just to drive home the point, and I'll try and pull that up on the screen as well.
Well, I think if you look at it, I mean, a quant fund, for example, quant flexi cap, which was one of the higher performing funds. That one's performance has come down. And if you look at, like, Parag Parikh, which is of course an all-time favorite of mine, and I would say for a lot of advisors, and I hear a lot of people also having Parag Parikh as well. And it was not one of the top performers in the September end, but when you look at it now, it is one of the top performers. So yeah, there are many other cases like this as well. Again, where funds were not there, who were not top performers in September, just in a matter of 4 months have come up at the top.
Okay, so 4 months can change quite a bit, and since that high point, Santosh, we're talking about drawdowns of over 15% for the broader markets, right? So obviously schemes that were more aggressive in their allocation towards the broader markets have seen drawdowns. But do you want to add to the data points that Mrin has pointed out, maybe some of the reasons why some of the schemes that sat at the top of the ranking in September have fallen down in January?
Yes, Alex, I think what we could do is we could take, September end being the high point of most of the, top chart busters, and, look at them today towards the end of Jan, or maybe even right now. The numbers are very different from where they were about 3.5, 4 months ago to where they were today. Let's take an example. If you were to look at the flexi cap or even the multi-cap category, there were winners in both the category. And let's take, as on September end, a classic all-weather fund like HDFC FlexiCap was not there in the list of good performers. But the minute you change the date to and come to early February this year, you suddenly see that HDFC FlexiCap has come right on top in terms of the way it's performed and the resilience it has shown against a sudden sharp correction in the markets. Likewise, the favorite of last year, like a Quant or even a JM Flexi Cap fund, which did so well up until September, October, right now seems to be also taken so much of the brunt in terms of the correction. So what is the learning over here? The winners up until September, October are not in the top list, and the guys that were missing in that list for maybe the whole of calendar year 24 or till the markets kind of peaked out in September, October, the guys who are not performing then are performing now. Of course, we can discuss their portfolio moves, their cash holding, or their exposure to mid and small cap and the broader markets. But fact is, they have changed, and they changed in terms of diametrically that the names and the winners are different.
Okay, Mrin, what do you do with this data, with this information then? And ultimately, the bottom line is, how do you choose? Because if you're not choosing the winners in any given period of time, and here we're talking about point to point, so obviously you zoom out, but it's not always available. That data is not always available, particularly if we're talking about the two categories that I've chosen. And maybe that's a little bit of a googly for you to say that because these categories, split not too long back, you can't go too far back in terms of the data available. So from that perspective, how do you choose?
So the first question is that what do you do at this point in time if you have these funds and where you're seeing a huge amount of volatility or you're seeing a big drop and you're feeling concerned about it? I think you need to really evaluate, why did you get into this fund and for how long did you get into this fund for? I think it's also important to go back and look at how this fund has performed at different periods of time. And I'll be honest, Alex, I don't think that individuals can really do this on their own. You certainly need the help of a financial advisor. Now, one of the aspects when you're choosing funds, which investors tend to miss out, is the rolling returns, because that is a better way to look at the consistency of returns, where essentially the returns are taken over a period of time, and you are checking on a daily basis that how the performance has been, and then getting an average. So it's like an average annualized return that you're getting over a long period of time. So first and foremost, since equity is meant for the long term, you would want to look at 7 to 10 year returns, and you would want to look at the rolling returns over there. Again, rolling returns data is not very easily available online for anybody to just go and check. And again, which is why you would need to take the help of an advisor. But this is what I would really suggest, that if you really want to evaluate and do a review of your mutual funds, you really need to go back, see what has been the long-term performance of this category. And I know flexi-cap and multi-cap, because of the scheme categorization, the data may not be too long, but even then you might want to go back, look at the consistency of returns that have happened over the years, and then really see whether you want to continue holding this fund or not.
Okay, so let's come to the clincher then, Santosh, which is in these two categories, and these are investor favorites for obvious reasons. Multi-cap has done incredibly well because of the forced allocation in the broader markets, and a lot of these schemes have pivoted over the course of the last several months to have a higher large cap allocation. But given the data that is currently available from your perspective, what are the schemes that you like and why, based on the strategies that they employ?
So, Alex, you're right that both the flexi cap and the multi cap are what we call the diversified equity category. Just the difference between the flexi cap and the multi cap is in a multi cap, you actually have a forced minimum requirement for broader markets, that is mid and small cap, and then the large cap. Whereas in a flexi cap, you do have the cushion given to the fund manager to decide upon the exposure to the broader market and the amount he wants or the lack thereof. Now, essential dipstick would tell you that, these funds, if you were to start looking at them from the way they are positioned and the way the exposure to broader market is, it will give you some sort of a macro view about how these funds are positioned. And I think I agree with almost all of what Mrin said in terms of how you have to check on track record and check on, rolling returns and check on how these funds have done in the past. But coming back to the way we are right now, I still think that if there's a flexi cap right now that has been more resilient to the market. Now, when you look at that, Parag Parikh stands out. HDFC stands out. Even in as part of such a sharp correction, even a fund like Edelweiss stands out. What are we looking at here? We're looking at how much did you capture in the upside and how much did you fall on the downside. Not all can get all the times right, but if you're able to do better both on the upside and on the downside, then you have a case for saying, I'd like this fund to be in my portfolio through market cycles. Now, sometimes the data that we are crunching is such a short period since the correction has started. 1.5, 2 months down from here, if the markets are back to all-time highs, then again, you'll have a distortion of data. So we have to be clear. It's also to do with the positioning. It's got little to do with what I think is my favorite right now, but it's got more to do how the fund is positioned. Let's take JM FlexiCap. Had a good exposure to broader markets, outperformed for 2-3 years and came top of the charts with huge margins. Now they have taken a beating, but again, broader markets perform like how just today in the second half of the day you had a recovery. You will notice that again, the funds which are holding more cash or more large cap oriented will tend to dip, and these funds will do well. I think positioning, understanding the positioning along with some sort of track record makes a great case for staying invested.
Okay. Fantastic. So we've given our viewers a bit of a sense as to how to approach this, and ultimately the bottom line, I'm sure both of you will agree, is to not take knee-jerk reactions if you are investing. And when the chips are down, the SIP approach or the SIP approach really allows you to accumulate more units. So that should be the objective, unless there is a very dramatic underperformance. Santosh, Mrin, thanks so much for joining in. As always, pleasure speaking with you.
Thanks, Alex.
Thank you.
And with that,